Someone just paid $100 for something worth $25. Not because they were stupid, not because they were uninformed, because they wanted SpaceX exposure so badly that they never stopped to check what they were actually buying. This has been happening for years. It happened before the IPO, it happened on day one. It is happening right now. And if you own SpaceX stock, or you are thinking about buying it, there is a very specific mistake that has already cost retail investors billions of dollars in the last few weeks alone. The mistake is not buying SpaceX. SpaceX is a genuinely extraordinary company. The mistake is how people buy it, when they buy it, and what they think they are buying when they click the purchase button. Here's what makes this genuinely dangerous. The mistake is not obvious. It feels rational. It feels like enthusiasm for a great company. It feels like getting in early on something historic. But the math underneath tells a completely different story. Today, we are going to walk through all three versions of this mistake: the one that happened before the IPO, the one that happened on day one, and the one that is quietly setting up right now. Real numbers, real examples, real people who paid real money for something they did not fully understand. By the end, you will know exactly what to avoid, and if you do want SpaceX exposure, the only sensible way to think about getting it. The mistake that started before the IPO. For over 20 years, SpaceX was completely off limits to everyday investors. SEC regulations under Rule 501 of Regulation D restricted primary access to SpaceX funding rounds to accredited investors only, individuals with $200,000 or more in annual income or a net worth exceeding $1 million. If you did not clear that bar, which the vast majority of Americans do not, you could not buy SpaceX shares directly, period. But here's what happens when a company becomes culturally iconic before it becomes publicly accessible. A gray market grows up around it. Retail investors who desperately wanted SpaceX exposure before June 2026 had two main options. Both of them were traps. The first trap was unregistered special purpose vehicles, SPVs, that marketed themselves online as ways for regular investors to buy pre-IPO SpaceX shares. These structures frequently operated with unauthorized synthetic contracts, fraudulent claims of actual allocation, and hidden fee structures exceeding 20%. Some were outright scams. Others were technically legal, but so loaded with fees and structural complexity that the investor had almost no chance of ever seeing a meaningful return, even if SpaceX performed perfectly. The second trap was more subtle, and in some ways more dangerous because it was listed on a real exchange. Destiny Tech 100, ticker symbol DXYZ on the NYSE. This was a closed-end fund that held a portfolio of private technology companies, including approximately a 16.2% allocation to SpaceX. Retail investors who wanted SpaceX exposure poured money into it. The fund was real. The SpaceX allocation was real. The price was completely disconnected from reality. At various points in 2024 and 2025, DXYZ traded at share prices between $70 and $100. The actual net asset value of the fund, what the underlying holdings were actually worth, was approximately $19.97 per share. Investors were paying a 300% markup, 300%, to own a fund that held a small allocation to SpaceX alongside other private companies. Every dollar they put in was buying them 25 cents of actual underlying asset value. When SpaceX finally went public in June 2026 and direct ownership became available on NASDAQ, DXYZ experienced severe downward volatility. The premium that retail investors had been paying to access SpaceX indirectly evaporated almost immediately. The people who bought DXYZ at $90 were left underwater, while investors who simply waited and bought SPCX directly on the exchange paid a fraction of the effective price. The lesson from the pre-IPO era is simple and brutal. Desperation to own a great company made people pay 3 times fair value for a fraction of the thing they actually wanted. But here's the thing. The people who avoided those traps and waited patiently for the IPO, the ones who did everything right, many of them walked straight into an entirely different version of the same mistake, just with a different price tag. The mistake that happened on day one. June 12, 2026, SpaceX officially begins trading on the NASDAQ under the ticker SPCX. IPO price, $135 per share, the largest IPO in American history, raising approximately $75 billion, a company valued at $1.77 trillion on its first day of public trading. For retail investors who had been locked out of SpaceX for 2 decades, this felt like the moment. The door finally opened and millions rushed through it. The stock closed day one at approximately $160. Then it kept going. By June 16th, 4 days after the IPO, SPCX hit an intraday high of $225.64 per share, a 67% surge from the IPO price in less than a week. And that's exactly when the most concentrated version of the mistake happened. Retail investors who missed the $135 IPO allocation saw the stock at $225 and made a decision that felt logical in the moment. The stock is going up, SpaceX is an incredible company, I need to get in before it goes higher. They bought at $225. Within 2 weeks, the stock had dropped over 30% back toward the $150 range. The investors who bought at the peak had lost nearly a third of their money before SpaceX had reported a single quarter of earnings as a public company. This is not a random outcome. This is a completely predictable structural pattern that plays out in almost every major hyped IPO. Here's why it happens every single time. When SpaceX priced its IPO at $135, that price went almost entirely to large institutions and insiders. Approximately 30% of the allocation was directed towards retail investors through platforms like Schwab, Fidelity, Robinhood, and E-Trade. But even with that unusually large retail slice, demand so far exceeded supply that most retail investors who wanted in at $135 couldn't get in at $135. So when the stock opened for public trading, the people who had been allocated shares at $135 began selling into the enthusiasm of the people who had not gotten an allocation. The price went up because demand from latecomers exceeded the supply of available shares. The institutional buyers who paid $135 used the retail buying frenzy as their exit. The people who bought at $225 were not getting in early. They were the last buyers in a relay race, receiving the baton at the highest possible price from the people who had run the first leg at a fraction of the cost. And the company underneath that $225 price tag? In 2025, SpaceX generated $18.7 billion in revenue and lost $4.9 billion. In the first quarter of 2026 alone, the net loss was nearly $5 billion. The XIA merger completed in February 2026 added significant GPU and data center capital expenditure requirements on top of an already capital-intensive rocket development business. At $225 per share, SpaceX was trading at over 100 times its annual revenue for a company losing money. The brand was extraordinary, the business was real, the price was not. Now here is what nobody is talking about. The first 2 mistakes are in the past, but there's a third version of this mistake that is quietly setting up right now, and it is affecting people who currently own SPSX and have no idea what is about to happen to the supply of shares in this market. The mistake that is happening right now. When a company goes public, the founders, early employees, and venture capital funds that own shares before the IPO cannot sell immediately. They are locked up, contractually restricted from selling into the market for a specified period, typically 180 days, to prevent a massive supply flood from destroying the stock price on day one. SpaceX implemented a multi-stage lockup structure, and understanding the structure is the difference between making an informed decision and walking into a supply shock with no warning. Here's how the unlock schedule works. After SpaceX reports its first quarterly earnings as a public company, expected in late July or early August 2026, approximately 20% of all locked insider shares immediately become eligible for sale. That represents hundreds of millions of shares hitting the market in a single window. If the stock is trading above approximately $175.50 for 5 of the 10 trading days around that earnings release, an additional tranche unlocks on top of the 20%. Then, additional 7% tranches release on a monthly basis through the remainder of 2026. By early December 2026, approximately 40% of all shares could be tradable. The remaining 60%, including Elon Musk's personal stake, stays locked until mid-2027. Now, think about what this means for the current price. The people getting unlocked in August are insiders and venture capital funds who received their shares at a fraction of the IPO price. Some of them received shares years ago when SpaceX was valued at $150 billion or $350 billion. The stock is currently trading near $150 per share, with an implied market cap approaching $2 trillion. These insiders are sitting on returns of 500%, 1,000%, sometimes more, and in August, they are legally allowed to sell for the first time. They do not all need to sell, but historically, the pattern is consistent and documented. When Facebook's multi-stage lockup expired in 2012, the stock fell over 40% from its IPO price before recovering. When Uber's lockup expired in 2019, the stock dropped to 43% below its IPO price. When Rivian's lockup expired in 2022, Ford Motor Company immediately dumped 15 million shares the moment the window opened. These are not accidents. They are the predictable result of supply increasing faster than demand can absorb it at exactly the moment when the initial retail buying enthusiasm has already cooled. The mistake retail investors are making right now is owning SPSX or considering buying it without understanding that the supply environment is about to change dramatically. At the current price, SpaceX trades at approximately 40 to 50 times forward price to sales. Even the most bullish analysts, and 25 out of 26 covering analysts, currently rate SPSX a buy with a median 12-month target of $205, acknowledge that this valuation requires flawless execution across Starship commercial deployment, global Starlink expansion, and deep space AI infrastructure simultaneously. One institutional research summary put it this way: buying during post-hype pullbacks is the only sensible entry, not during parabolic rallies, not before understanding the lockup mechanics, during the digestion period that follows the supply shock. What to do instead? Let's be clear about something important before we get to the framework. SpaceX is not a bad company. By almost any operational measure, it is one of the most remarkable enterprises ever built. In 2025, it conducted 165 orbital launches, roughly 85% of all U.S. orbital missions. Starlink has approximately 10 million subscribers across 164 countries, generating $11.4 billion in revenue. The Falcon 9 reuse rate is approaching 98%. These are genuinely extraordinary numbers. The mistake is not caring about SpaceX. The mistake is paying prices that require the company to execute perfectly across every initiative for the next decade just to justify what you paid. So here's the framework that avoids all three mistakes. First, never buy indirect proxies at premiums to NAV. If you're accessing SpaceX through a closed-end fund or SPV, check the premium before you buy anything. If a fund is trading at more than 10% above its stated NAV, you're paying extra for nothing. Direct shares on NASDAQ are always preferable to synthetic exposure at a markup. Second, Never chase parabolic post-IPO moves. The pattern is consistent across every major hyped IPO. The stock surges in the first week as retail enthusiasm meets constrained supply. Then it corrects as institutional sellers use that enthusiasm as their exit. Buying into the surge is buying at the worst risk-reward moment in the entire post-IPO cycle. Third, understand the lockup calendar before you buy. The August unlock is documented and confirmed. The tranches that follow through December are disclosed in the IPO filings. Buying before the lockup digestion period completes means buying before the real supply-demand equilibrium has been established. The price after the supply shock settles is almost always more honest than the price before it. Fourth, if you want SpaceX exposure, dollar cost average during the lockup digestion period rather than deploying a lump sum. Buy a portion now, buy a portion after the first earnings unlock, buy a portion after the next tranche. Let the supply find the market. Let the price reflect the business rather than the brand. The investors who made money on Amazon, Google, and Apple weren't the ones who bought on day one at peak excitement. They were the ones who bought at reasonable prices after the initial mania had cleared, and then held for years while the actual business caught up to the valuation. SpaceX has the potential to be exactly that kind of long-term holding, but only if you enter at a price that reflects the business, not the story. 3 mistakes, 3 versions of the same fundamental error. The pre-IPO trap, paying 300% premium through proxy funds and unregistered SPVs to own a fraction of an indirect exposure to a company you could have waited to buy directly. The day one trap, buying at $225 during a retail frenzy driven by a constrained float and institutional selling, then watching 30% disappear in 2 weeks as the hype normalized. And the current trap, owning or buying SPSX without understanding that a major supply expansion is coming in August as insider lockups begin to expire, into a stock already trading at 40 to 50 times forward price to sales. The company is real, the technology is extraordinary, the opportunity may be genuine over a long enough time horizon, but the price you pay determines everything, and right now, the calendar, the lockup structure, and the valuation all point to the same conclusion. The sensible entry is not today at the peak of enthusiasm. It's after the supply shock, after the lockup digestion, after the price has had a chance to reflect the business rather than the brand. But here's the question. This video did not answer. What do you do with the money while you wait? Because the investors who understand the SpaceX lockup mechanics and choose to stay on the sidelines for now, they're not just sitting in cash. They're deploying that capital into structures that generate returns completely correlated to what happens in the SpaceX lockup window. Litigation finance, generating 15 to 30% IRR from court outcomes that have nothing to do with Elon Musk or the NASDAQ. Farmland, delivering 10.4 annualized returns with near zero correlation to public equities. Private credit structures, compounding tax-free inside PPLI wrappers while the SpaceX lockup storm plays out. The sophisticated investor doesn't just avoid the mistake, they deploy the capital they saved from avoiding it into something better while they wait. That's exactly what the next video maps out.